Today we want to finish up the insurance accounting and then get into Schedule P analysis. So we hinted at premiums last time. The key is this term premiums earned. What did you actually earn? So that's very much a GAAP accounting concept of earned. You know, if you have premiums that you've received but you haven't earned them yet, or premiums that you've earned but you haven't received them yet. From a GAAP accounting standpoint, you have unearned revenues, you have accounts receivable. And remember, in insurance, if someone owes you a premium and they haven't paid you, you cannot count that as premiums earned because you're not required to pay your auto insurance premium. It's not a contract. If you don't pay, it's not like your rent. If you don't pay your rent, they can put that as an accounts receivable and you have to pay the rent because you're staying in the apartment or whatever. But with auto insurance, you don't pay your auto insurance, they can't go after you with the bill collector. You simply lose your insurance. So there is unearned revenue where people pay their premiums in advance, but there's really not a true premium receivable in the sense that you think about it from a GAAP term. So it's a little bit different. But then we throw in this other term, which is unearned premiums. Do not think of unearned premiums as unearned revenue like you see in GAAP accounting. You know, so if you have an apartment and you pay your apartment rent on March 30th for the month of April, then on March 30th they have unearned revenue, and they don't earn that revenue fully until the end of the next month. So they have essentially a prepaid revenue. That's a liability. That is not what unearned premiums are in insurance. We have to understand it's a strange concept, and it's very much property and casualty, much more than it is life insurance. So when do we recognize the revenue? That's premiums earned. So there's a few dates that are interesting. One is when you sign the policy. When you sign that policy or when the policy renews, what they do, this is where we have what we call written premiums. A written premium is that full contract premium on the day the policy is signed. And so insurance has a concept of written premium. It's a very strange concept. It is definitely not an earned premium. So what they mean is we're now on the hook for this policy. So if you have a 9-month policy, you pay $100 a month. On the first month, on the first day of the first month, they have premiums written of $900. 9 months times $100. Whether you paid it or not, the written premium is $900. Now, if you ever stop paying the premium, that written can go away because the policy gets canceled. But on the first day of the first month of those 9 months, they have 9 months of written premium. That's $900. Right? So that's written premiums. That is not earned. So premiums are written on the day of the contract. Then you have premium that is due. That's more of an accounts receivable type of thing. You'll see that more in life insurance. You don't really have that in property and casualty. But there is the date the premium's actually received in cash. Well, you don't earn the premium when you receive it in cash. Cash, just like in any GAAP accounting, cash is just when the cash is received or whatever. You know, there's an accrual process here. So when the policy becomes effective, the premium is written. The premium is 100% written on the day the policy is assigned, when the contract is signed, or where you commit yourself, the insurance company commits themselves to the policy. So we talked about the premium, the surplus ratio. Remember that 3-to-1. I was using that somewhat soppily because we were applying it to the earned premium. But really, premium to surplus ratios, that 3-to-1 really applies to written premiums. What's your written premiums to your net worth? And remember, when I say surplus, that's their net worth. Over time, the risk runs off. You know, so you give them 3 months of coverage, then 4 months, then 5. Then at the end of 9 months, all that written premium is gone. It's used up. And now you start a new policy and you have new written premium. So the earned premium is what the firm has actually earned by the passage of time. So on day 1 of 9 months, the premium is 100% written. At the end of the first month, it's 1/9 earned and 8/9 of a month unearned. All right, so let's say the policy is signed on March 1st, becomes effective on May 1st, and it's a 12-month problem. So I say when I think I said before in the policy side, it means when it goes effective, when you're actually covered. So on March 31st, nothing's happened. The actual date that something happens is May 1st because that's when coverage. So if you had an accident in April, you wouldn't get any insurance. Even though you signed the policy on March 1st, it's effective May 1st. Now, I don't know why you would do that. That would be awfully strange. Obviously, if you buy a new insurance policy, you would want it to be effective immediately. But for some reason, they signed this policy on March 1st for a policy that starts May 1st. So you don't have written premiums until the policy goes effective. So on March 31st, nothing's happened. You signed the contract on March 1st, but on March 31st, there's nothing there. Now, what about June 30th? So you're 2 months within the policy period. So I'm doing these quarter ends, March 31st, June 30th. So this is a 12-month policy. So you've earned 2 months out of the 12. It's a $120 premium. So this looks like maybe it's a renter's policy or something. It's pretty inexpensive. So $120 premium. So essentially you're going to earn, the insurance company will earn $10 a month. So the written premium for the June 30th financials is the full $120. Once it goes effective, that full $120 is written. The unearned premium is the amount of that $120 that the company hasn't earned yet. So we've got 2 months that they've earned, and they've got 10 months they haven't. So their unearned premium reserve, remember this is a liability, is $100. It's the amount, because the written premium, they actually make an accounting entry for that. That's their written premium. It's not really going to show on the income statement. It's the earned premium that shows in the income statement. But written premium shows that they're on the hook. For the next 12 months, they're on the hook. But they've only earned 2 months worth, so they still have unearned revenue premium of $100. What is your earned premium? Your earned premium is your written premium minus the change in the unearned premium. So here you wrote $120. Your unearned premium went from 0 to 100. So 120 minus 100 is $20. Or you have May and June at $10 a month. You have 2 months, you earn $20. So this is a pretty important formula. The earned premium is the written premiums minus the change in the unearned. And the unearned premium is like unearned revenue in a way. It's strange. You wouldn't think, why do you have this liability on your books? And the reason you have it on the books is because you put the written premiums on your books. But it's really bizarre. It's just the way insurance is set up. They set up this written premium, which shows up on the balance sheet. Because that's on the balance sheet, you haven't earned anything. You have to put this unearned premium. So you notice none of this has anything to do with cash. They haven't received any, and you notice that receiving cash from the policyholder has no impact on this. So it's like the cash is just completely outside this entire. It's so bizarre, not like any other type of accounting. On September 30th, your written premiums are still $120. You're 5 months into the coverage. So your unearned premium is now $70. You have 7 months left, $70. So your earned premium now is $120 minus $70. At year end, your written premium is still $120. Your unearned premium is now $40. So your earned premium is now $80. And you have 4 months. And so remember, this unearned premium, we'll look at it when we look at the financial statements. It is a liability on the financial statements of insurance companies. We already talked about the premium to surplus ratio. And again, cash payments have no impact on any of this. There are other premium accounts, premium receivables. After the premium is written and the time to collect, that's kind of like a normal receivable, except this should not be an asset because it's not legally owed. However, because you had to set up the unearned premium, which had nothing to do with the cash payments. Remember, in most companies, unearned revenue is you receive the cash, but you haven't earned it yet. So we set up an unearned revenue. That's not the case here. That unearned premium reserve has nothing to do with you collected premiums on something you haven't yet earned. Unearned premium has to do with the fact that you're setting up the written premiums when the contract is signed. So you have to say, why do we have this premium receivable? It's just to offset this liability that we have that's too large. It's kind of strange. So, and the expectation is, because, remember, these companies are writing at combined ratios of like 100, 95, 96. The thought is that most of this premium, when it becomes earned, is going to move into the liabilities, the reserves, the loss adjustment reserve, or the loss reserve. And so the thought is it's going to move from the earned premium reserve into the other reserves, the loss reserves, because 95 to 100% of the premium will be paid out to the policyholder eventually. So that's just the logic. It's just they just take, as you take on the risk moves from this strange thing called unearned premium reserve, and then it moves into the loss reserves. Not all of it. 4 or 5% of it will actually become earnings, but the vast majority of it will. All right, so there's the premium. I'm not really going to test y'all on the premiums, but you should know it if you're going to interview with the company. If you're going to take the actuarial exams, these will all be covered. One last thing, and we'll see this when we're going to look at Allstate, is the concept of a holding company. Holding companies are real common in banking and insurance, and it's because banks and insurance companies are heavily regulated entities. And firms that go out and borrow in the public market or have stock that they issue in the public market, they don't want to borrow in public markets from a regulated entity. They don't want to issue stock from a regulated entity. And so what they do is they create a company above the insurance company or above the bank that owns the insurance company, owns the bank, and then that holding company, completely unregulated firm, it's the one that issues debt or issues stock. So heavily regulated entities tend to have holding companies. We'll see that's the case with Allstate. Now, USAA is interesting. USAA cannot have a holding company on top because it's a reciprocal. It's owned by its policyholders, so its main parent company has to be an insurance company. But USAA does have a holding company. In fact, I was an employee of their holding company. It's called the Capital Corporation, and it's a subsidiary of the insurance company, but it's a non-regulated holding company in between. It owns the real estate company and the other insurance companies. It's there in between, but it's the one that's unregulated and actually goes out and borrows the money for USAA. Obviously, it doesn't issue any stock because USAA is not publicly traded. Now, I don't know about Farmers and State Farm, how they have it set up, but USAA does have a holding company. It's just that it's not the highest entity. It's actually below their reciprocal company. Now, if you go and work for a company, an insurance company, you might check and see if they have the database. The SNL database has nothing to do with Saturday Night Live, and I don't remember what SNL stands for, but it's a company that provides a lot of data on insurance companies and banks. And one thing their database has is all of the statutory financials for all insurance companies. And that's, you're going to see, I'm going to show you here pretty soon with Allstate that that statutory information is actually quite valuable. We're going to look at the Schedule P here hopefully today and see how valuable that data is, and all of that is available. Now, I don't know, at USAA they had access to this database. My best friend that worked there, you could just call him. If you went to USAA, you could just call him and he would tell you how to get access. But he went over with Victory Capital, so I don't know who the contact is now. But most firms have a corporate library. So if you go and ask them, so USAA probably still has access to SNL. And we actually had an intern, our financial access person, entry-level finance person, really sharp guy. And I actually, at the year I was retiring, I asked him to do a big project using SNL, and he did a great job of putting together the data to look at USAA versus all of these competitors. You can get a lot of data. I love this. It's the statutory information. I love it because it's really rich and deep information, very detailed. So check with your company, and if they don't have it, you might ask them to do a subscription because it is really good information, not just on insurance companies, but insurance companies and banks. They have a lot of the statutory filings that these entities do, and that's really powerful information. One of the pieces of data that you can get access to using S&L is the risk-based capital data. You cannot get to that using GAAP financials from their public SEC filings. So you have to get that from the S&L. I'm going to actually show you that when we do Allstate. But risk-based capital, insurance companies have this, banks have this. It's essentially what regulators are saying your net worth needs to be relative to your risk, and they call it surplus or capital. But essentially, remember, insurance companies and banks, when we use the word capital, we mean the net worth. Insurance companies use the word surplus to mean capital or net worth. It's, we have a lot of terms for the same thing. Regulators have these models. Rating agencies have these models. In fact, I got to test some of the rating agency models for them because I had access to S&L and they didn't. The rating agencies didn't, and so they would actually come to me with their models to run their models. It was just a tremendous advantage to be able to do that and see in advance what they were thinking about. Or you might have your own internal models. So again, net worth of the firm, the surplus of the firm, the capital of the firm, that's the cushion they have against some major catastrophic loss. So risk-based capital says how much net worth do you need based on the formula that somehow captures the risk of the company. Banks do the same thing. It's called risk-weighted assets. Very similar concept. Some things are more risky than others. It's a more sophisticated capital ratio than the premium to surplus ratio we're using for the pricing example. For my life insurance class, we actually use the risk-based capital for the policy pricing there. And what the risk-based capital does is it has categories of risk. C1, C2, C3, and C4. C1 is the asset risk. And they exclude interest rate risk under C1. They cover that under C3. But asset risk. So insurance companies, we'll talk about this, property and casualty companies tend to have higher allocations to stock than other insurance companies. A lot more life insurance companies tend not to have anything in stocks, but a typical P&C company have an allocation to stock. This risk-based capital says for every dollar you have invested in the stock market, you need to set aside 20% of that in net worth. So if you have $1 billion in stocks, you're going to need $200 million in net worth to offset that risk. They don't require any capital for treasuries. We know treasuries are risky, but from an interest rate standpoint, but we don't consider them risky from a credit risk standpoint. Triple B bonds, you have a 1% charge. Junk bonds, these below investment grade bonds, a 15% charge. And subsidiaries, they essentially, they don't like the stacking of capital. They don't like you triple counting a net worth that you have set aside for other subsidiaries. And so there the charge might be 100%. So if you've got $500 million invested in a life insurance company, they're going to say, well, that entire $500 million is needed for the risk of that company. And so therefore, we're going to make the capital charge 100%. They might look at concentration, and that's a really tough one to see if you have too much in one entity. That's a really tough one to calculate. C2 risk, really big one for property and casualty companies, and that's their insurance risk. Mainly looking at your risk of your pricing is just not adequate. You didn't charge enough for your auto insurance, or you have a major catastrophe. It could just be their probable maximum loss. The problem with using PML for C2 risk is that's an internal model that the company runs, so it's hard to put that into a model that the regulators can use for all companies. They've actually struggled on how to measure catastrophic risk for insurance companies. C3 is interest rate risk. That's mainly for life insurance companies because their assets and liabilities are both interest rate sensitive, and so their goal is to make sure they're matching those up. And then C4 risk, they say other, or they call it business risk. It's mainly the risk insurance companies have if there's a major insolvency in the industry. There's these things called guarantee associations, which means when the company goes under, all the other insurers have to bail that company out. And so C4 risk is a risk that's just a catch-all. If the industry is having a lot of insolvencies, then you need to hold some net worth to cover your share of bailing out the industry. It's a little bit of an over measurement because the interesting thing is it looks like the insurance industry is insuring itself. If one of the companies goes under, the rest of the industry bails it out, but that's not really true because insurance companies pay a lot of tax to the states in the form of premium taxes, but when they pay these guarantee association charges, they get to offset that against their premium tax. So if they were paying a $10 million in premium taxes and they had an $8 million guarantee association charge, they can offset that, and so they only have to pay $2 million in premium tax. So ultimately, I think the taxpayers in the state end up, taxpayers don't pay for the insolvency, but they get less premium tax, and so ultimately, indirectly, they pay for it. So let's say you have a portfolio that has 2 risks in it. What is the combined risk of that portfolio? This will help you understand how they combine these 4 risks into one number. So the combined risk of those 2 risks is the risk A squared plus the risk B squared. Now I know some of y'all know there's supposed to be a weight there, but we're doing this in dollars. So if you're doing it in dollars, the weight's part of the dollar. So the A risk squared, B risk squared, 2 times A risk, B risk times the correlation of the 2. If the correlation is 1, then the combined risk, you just add the 2 risks together. This will all simplify down to the standard deviation A plus the standard deviation of B. If the risks are 1, if the correlation is 1. If the correlation is 0, then what this comes down to is essentially this A squared plus B squared and taking the square root of that. That gives you a different number, and I'll show you why it gives you a different number. So when the correlation is 0, you add the 2 things to get, you square the 2 things and add them and take the square root. If the correlation is 1, you just add the 2 risks together. So what does that mean? Let me just show you why I say that. So you could do A squared plus B square and take the square root of that. Or you could take A plus B and square that and then take the square root of that. Well, this second one is just going to equal A plus B, obviously. But this first one will be a smaller number. Why do we say that? Well, let's say A equals 3 and B equals 5. Well, in this first one the second one we get 3 plus 5, that's 8, squared, that's 64. You take the square root of 64, you're going to get 8, which is just 3 plus 5. But on this one, you're going to get 3 squared, which is 9, plus B squared, which is 25. Take the square root of that, that's going to equal the square root of 34. If you take the square root of 34, you get 5.83, and 5.83 is less than 8. And that's the benefit of diversification, because A and B are not correlated. When you add them, when you square them and then add the squared numbers and then take the square root, you'll get a smaller number than if you just add the 2 together. Alright? So if we square things and then add them and then take the square root, we're essentially assuming that the correlation is 0. Alright? And so if we look at the actual risk-based capital formula, they take C1 risk plus C3 risk and then add them and then square. That is going to give you the same thing if you were just to add them together. That's like correlation being 1. But then if you take something and square it and add it to something else, square it, and take the square root of that, that's as if the correlation between these 2 together, C1, C3, what's their correlation to C2? And that's 0. So they're essentially saying C1 risk and C3 risk are perfectly positively correlated, and that makes sense because C1 is asset risk, C3 is interest rate risk. But they're assuming that C1, C3 combined is uncorrelated to C2 risk, and that makes sense. That insurance risk would be uncorrelated to asset and interest rate risk. And at the very end, you just add C4 risk in. There you're assuming that C4 is perfectly positively correlated to all the others in the way they're combined. And that makes sense because C4 risk is talking about the risk of insolvency. Obviously, if there's a major stock market drop, interest rates are going wild, and big catastrophes, that's the time where most companies, you're going to see more insolvencies in the industry, so it makes sense to do that. So that's how they handle risk-based capital and combining them together. It's an interesting approach. Actually, the reason I'm showing you this is not a bad way to manage risk. So you've got to somehow figure out how to combine risk across a company. And my boss, when I first did this, UTSA had a list of like 90-something risk, and he was wanting me to come up with a correlation between all of those risks, a correlation table which was 99 by 99. It would have been crazy. I said, why can't I just take all the risk and we'll just say generally, are they highly correlated risk or highly uncorrelated risk? Do we square them, then add and take the square root, or do we add them, or do we just add them? If we square, then add, then take the square root, we assume the correlation is 0. If we just add them, we assume the correlation is 1. He didn't like that approach, but I loved it. I was stealing that from the risk-based capital formula. We'll definitely look at the reserve. We're going to actually do this. It's how much they ultimately think they're going to pay out minus what they've already paid to date. So we'll go through all states. You have some notes here. You might look at these notes while you're watching me go through. I'll go essentially in this order, maybe not entirely through everything, but essentially through this order. Alright, so this is going to be a little tough to read. I know it's really small, but what I'll do is I'll have to jump out of PowerPoint every once in a while to expand things so you can see a little better. Sometimes it doesn't really matter. You can get this yourself. You go to allstate.com and go to Investor Relations, click on Financials, find their statutory financials. I'm just doing their 2020 AIC, which is Allstate Insurance Company's financials, and that's exactly the page I'm using here. So the very first page is called the Jurat page, and it just tells you who this insurance company is. It gives you their group code, which is all the Allstate companies, and gives you their company code. Now this is the Allstate Insurance Company, the highest ranking company. It's not the holding company. This is the largest, most senior insurance company for Allstate. Gives you information on the company, gives you some contacts, like who the chief accountant is, tells you who the board is. And there's some real strict rules on the board members. Officers and directors of the firm, and the real strict rules. Some of these people have probably been challenged because they didn't put their full name. The rules when we were doing this is you have to put your full name with no abbreviations. Abbreviations are absolutely not allowed. And we had an officer whose name was a letter. I think it was A was his first name. And he went by his second name. So his first name was A, and we would send it into the States as A, I forget the rest of his name, A Stacer or something, and they would send it back and say no abbreviations, and we'd have to almost send his birth certificate. So there's a lot of rules. These are regulated financial statements. These are statutory. These are what the states require. There's a whole plethora of rules and regulations that you have to follow. It's signed by certain people. Obviously the actuary is the most critical one to sign here, but there's actually, you don't see the actuary down here because there's actually a separate statement that I don't have access to, that the actuary signs, the chief actuary signs to say, hey, these financials were prepared correctly according to actuarial standards. The next page is the assets. And if you look, we'll look at this in more detail. You don't need to see it close up. This is like $32 billion in assets, the very first asset. This looks a lot different than what you see if you go to the GAAP financials. GAAP financials, balance sheets, the first item is cash and cash equivalents. That's not the way the statutory financials are done. The first line is the largest asset, which is bonds. So they start with investments. So bonds is the biggest number. It's about $32 billion for a firm that has about $55 billion in assets. So over 60% of their assets are in bonds. The second column here is not admitted assets. There are some things that state regulatory rules do not allow you to count as an investment or an asset. So you have to subtract that all out, and column 3 just shows you their admitted assets with the net. And then you have the prior year. So that's what this is. It's total assets. I'm going to show you the non-admitted asset schedule that shows you the kind of things they subtract out. You can see it's not a huge amount. It's a $55 billion company, and they subtract out less than $1 billion, but they do subtract out some stuff. A lot of them are like property, plant, and equipment, certain things, furniture and equipment. States just don't allow you to count those type of assets as assets. So you set it up, it's on your books, and then you have to write it off against net worth. So here's the assets, the bulk of the assets. If you look at the total for investments, which is this line, I know it's hard to see, but that's $47 billion. So $47 billion of their $54 billion are investments. And if you look down at the best investments, the bulk of that is bonds and stocks. Now this stocks number looks big. It's like $7.8 billion. Part of that are stocks that they bought in the stock market. But a big chunk of that is also stocks that are subsidiaries of theirs, their equity holdings. Allstate has a huge number in other invested assets, $5.5 billion. They're pretty unusual there. They have some partnerships and some options and other derivatives, so they have a larger number there than most companies do. But bottom line is, between those 3 items, you're getting to 80-90% of their assets. And that's true for most property and casualty companies. Most of their assets are going to be in bonds and stocks. Now they might have a home office. So here, this line here says properties occupied. That looks like a small number for Allstate. Who knows? For USAA, it's a huge number, but it might be a building that, they have different buildings owned by different subsidiaries, and this is just this subsidiary's portion of that. So I would not consider that an investment. So when I'm looking at the investments of a firm like Allstate, and you get that SNL database that I told you about, I'll subtract out the subsidiary investments, and I'll subtract out the occupied building, the firm's home office or their buildings. I'll subtract those out. I consider subsidiaries to not really be an investment. It's just part of the overall company. And then the home office, that to me is property, plant, and equipment. It should be down here with other property, plant, and equipment. So anyway, there's the assets. The next page is the liabilities. And again, you can't really see this, but I'll point it out. The top line are their loss reserves. That's about $14 billion. Then you have your loss adjustment reserves. That's about $4 billion. And then down here, you see the unearned premium reserve. That thing we just said, that's the reserve they set up. When the policy goes effective, that's that entire written premium goes into that reserve. And then as time passes, that reserve comes down. As they earn that premium, they go 1 month, 2 months, 3 months, that comes down. It's a liability that is so bizarre. You don't see it really in any other type of company. It's just really unusual. Usually when you see an unearned revenue, it's because you've collected money, but that's not the case here. The insurance company is saying, hey, you took the risk, and the premium you're going to get eventually reflects that risk. And so most of this $11 billion is going to move up and be part of this $13 billion, so we'll just move it between the two over time. So if you take that, $14 billion plus 4, that's $18 billion, plus another 11, we're getting close to $30 billion. $30 billion of their $34 billion in liabilities is their reserves. Those 3 reserves, loss adjustment reserves, and unearned premium reserves. So the bulk of the balance sheet of the liabilities are those insurance reserves. Now if you're an actuarial major, one job you could have is be a loss reserve actuary. I worked a lot with loss reserve actuaries, really great people, really very serious. I mean, they have a lot of rules, mathematical rules that they follow. They're very precise people. I always enjoyed working with them because it was like we knew exactly what they were after. They took their profession very, very seriously, and they had to. These are huge numbers, and if you just miss it by 5 or 6%, that 5 or 6%, that's a few $100 million. That's very material to their net worth, as we'll see when we look at Schedule P. So we'll get into this a little bit more when we look at Schedule P. There's not a whole lot more that's interesting here, with the one exception, is there is a line here that's called borrowed money. And this borrowed money, this is their debt. You notice that's zero. That doesn't mean Allstate doesn't borrow money, but if Allstate borrows money, they'll borrow it through their holding company and not through their insurance companies. So, USAA borrows a lot of money, billions of dollars of money, but if you go to their statutory financials, it looks like a zero. And that's because one of their subsidiaries that shows up in their stock on the asset page, one of the subsidiaries is essentially their holding company that goes out and borrows money. So insurance companies tend not to have borrowed money on a regulated entity. The rest of this down here is their net worth. It just shows you that they have $34 billion in liabilities and about $20 billion in net worth, which is called surplus here, and that ties back to their assets. Then you have the income statement. As we've already talked about, the income statement separates the underwriting, which is your premiums minus your losses, minus your loss adjustment expenses, minus your underwriting. Remember that combined ratio, which takes those as a percentage of premiums, and that gives you your underwriting. You notice that their net underwriting is a positive number, which means that their combined ratio is less than 1. They're paying out less than they're taking in, so that's good. And then the next section is hard to read, but it's their investment income. They separate their investment income from the underwriting. Very different than any other type of financial statement you will see, with the exception maybe of banks. Banks tend to do their interest income minus their interest expense and get net interest margin, and then they subtract out all their other expenses. So financials are different. They're a very different type of entity. This is very different from life insurance as well. Life insurance doesn't do that like this at all. Life insurance has premiums and investment income at the top, and then they start subtracting things out. So it's a little different when you're looking at financials, and that's why I say it's really tricky if you bring up these financials on Yahoo Finance. Yahoo Finance is going to stick these numbers into a typical GAAP financial statement that you would see for a Walmart or a CVS or an Exxon. That doesn't really make sense for an insurance company, and that's why I say the statutory financials, that's really the way most insurance people think. It's how it reflects in the statutory blanks. But anyway, there's their net income. They have the other type of typical stuff. You have taxes at the bottom. They do have dividends. They have dividends to stockholders, which comes out of their net worth, but they also have dividends to policyholders. Dividends to policyholders is actually part of net income. Dividends to stockholders is not part of net income. It comes out directly out of net worth. But dividends to policyholders, which you notice Allstate doesn't do that, but if they pay dividends to their policyholders, that's actually an expense that comes out of their net income. And then you have their capital accounts. There's a lot of detail on their capital accounts. Some of these are things you're used to from your GAAP accounting, like treasury stock when they buy back their own stock. A lot of these are not. There's a lot of really unusual items in here that you only see in insurance companies. If you get their financials, maybe if you've loaded Allstate, maybe I should have told you load Allstate and look at it before looking at this video. You can blow it up and see what these are. But you can see their net income in 2020 was $5.9 billion, much better than the prior year, $3.7 billion. So they had a good year. 2020, people weren't driving because of COVID-19, and Allstate's a big insurance carrier. You can see their underwriting gain was up significantly, like $1.6 billion, which looks like that explains almost the entire difference here. They just had a really good year, probably because their auto insurance claims being so low. We also didn't have any major catastrophes last year, hurricanes. Now I know 2021 we did have the big snowstorm in Texas that probably increased some claims for auto insurance, but probably not too dramatically. I doubt it was even classified as catastrophe. Winter storms can be considered catastrophic losses, but I don't think 2021 was, because people just weren't driving. Anyway, there's your income statement. Very different than an income statement you would see from most other companies. The cash flow statement, I'm just showing it to you because I'm going to tell you, you'll probably ignore it. I never use the cash flow statement when I'm looking at an insurance company, except for maybe looking at the financing side. Are they buying their stock back? Are they paying dividends? But the cash from operations for insurance companies and banks really doesn't mean anything. you may have taken some finance classes, corporate finance, maybe from Catapacum or Aguilar, where they talk about free cash flow. Free cash flow is a great concept, makes a lot of sense as a part of your analysis. I don't believe insurance companies and banks have something called free cash flow. I was a little leery of ever saying that. I mean, that's my background in banking and insurance. I was watching a presentation from a professor from New York Stern School of Business, Dr. Demodarian, very well known, very famous professor. He said the same thing, so they gave me a little more confidence that I wasn't way out there. And the reason for that is, the reason we don't typically look at cash from operations for insurance companies is when insurance companies have a lot of premiums come in, that means they've got a lot of risk coming in. Their premiums mean risk. And so what we think of free cash flow is really not free cash flow, because a lot of that cash flow is going to have to pay claims in the future. So we don't really use that concept of free cash flow with insurance companies. The other thing I'll show you, I'm not going to go into detail in here. I just want to let you know, if you're interviewing with a firm, the statutory statements, look at this detail. It tells you exactly what products they're in. So we go down and find the big ones. Here's a big one, $8.3 billion. These are their premiums. If you look at here, they got the written premiums, they have the unearned premium, and they have the earned premium. Remember, the unearned premium is the liability. Remember what I said earned premium was? It's the written premium plus the change in unearned premium. And so there's their, minus the change. So minus the change in unearned premium. So if unearned premium goes up, that brings down that number. So, so column 1 plus column 2 minus column 3. So they subtract the current year, they add the prior year, and they take this year's written premiums. So it's written premiums minus the change in unearned premium, and that's going to tell you what their earned premium is. And again, that's really interesting. There's no cash here at all. It doesn't really matter on the cash side. So if we go down and find the big numbers, $8.3 billion, that's homeowners. Well, we know Allstate does a lot of homeowners insurance. We come down again. Here's another big number, $12 billion. That's private passenger auto liability. That's auto liability. Come down a couple more lines. It's $9 billion. It's auto physical damage. We're really the $12 billion plus the $9 billion. That's $21 billion. $21 billion of their premiums, of their $32 billion premiums, is auto insurance. So Allstate, this particular Allstate company, is predominantly auto insurance. You can just see it in the numbers. You take the auto insurance, $21 billion, plus the homeowners, $8 billion. That gives you $29 billion. $29 billion out of the $32 billion. So 90% of their business is auto and home. What else out there is really huge? There's a few other that are probably more than likely related to homeowners. They do have some commercial insurance. They don't do much commercial insurance. It looks like about $1 billion or so is commercial insurance, commercial liability. But so Allstate is primarily a personal auto insurance, personal homeowners. Now, not only do you get the premiums at this level, you get a lot of other things like the claims, and so you can really get a lot of detail on the company out of their annual statement. They give a statement on their investment income. I don't think this is all that useful. I've used this statement before. It's not all that useful, but it's out there. You can get their investment income broken out, and you can get their capital gains. I'll show you that next. It is interesting on their investment income. They do a few bizarre things. One thing I thought was really strange that you see on statutory but you don't see in GAAP accounting is you saw Allstate had about $200 million in their home office, their own buildings. Well, statutory accounting, they have to pay rent to themselves. So that rent they give to themselves, that's investment income, and then the rent that they pay themselves is an underwriting expense. So essentially, if they pay themselves $20 million for rent, the $20 million increases their investment income, but also increases their underwriting expenses. So it doesn't have any impact on net income, but it does impact those. So you have to decide if that's a big part of their investment income, you might want to subtract that out so that you can compare one company to another company. So it's just strange. There are some strange rules for statutory accounting. Here's the capital gains. The capital gains, probably not all that interesting this year, but back in 2008, this would have been a very interesting schedule, looking at those large losses we had in that year. I talked about the non-admitted assets, so they do have a more detailed schedule here. I don't think it gives you that much more detail than what page 2 did on the assets, but it just shows you, if you wanted to look through this and see what kind of adjustments they're making. But the biggest one, so there's about $900 million in adjustments, and of that, almost $550 million of that is for property, plant, and equipment, electronic equipment, building, furniture, cars, those kind of things. So the bulk, over half of it, are those type of property, plant, and equipment type of items. One thing I love, and this is, if you're going to interview with a company, I would go find this schedule. It's the 5-year historical data. I do want to break into this a little bit more in more detail, and I'll show you why I want to. But the 5-year gives you all kind of data on their written premiums by type of product, their net income, their balance sheet, some key balance sheet items. We're going to talk about the risk-based capital, talks about their assets. We talked about a lot of those stocks are probably subsidiaries. So down here at the bottom, they show how much of the common stock are actually subsidiaries. You can see they had like $7 billion in stocks. About $6 billion of that was in subsidiaries, like their life insurance company, or another property and casualty company that only does business in New Jersey or something like that. So really good information. And there's 2 pages of it. We talked about the combined ratio. You can actually see the combined ratio. It's not done exactly like a combined ratio, but you could use this to actually back into a combined ratio. So if you added up these, well, actually the underwriting gain or loss, you can see that's 11.6%. That essentially tells you that their combined ratio would be about 88 or 88.4. And you can look at that over time. You can see 2020 was a great year for them. No hurricanes or earthquakes for the homeowner side, and people not driving very much on the auto insurance side. So they had a great year last year. All right, so let's come back and let's talk about the risk-based capital. All right, so if we look at the risk-based capital, it's hard. I know it's fuzzy, but they have one line it's called their total adjusted capital. If you go back to their balance sheet and look at their net worth, this is very close to their net worth. It's a very fuzzy number, but it's very close to their net worth. The next line, line 29, is their risk-based capital. It's called their authorized controlled level risk-based capital. So I'm going to put that in there. We're going to just guess at these numbers because they're really fuzzy. So we have total adjusted capital, and we have their authorized control level. And I'm going to put this on the exam because it's a good thing to know. So let's put that in there. Now I'm going to guess at the numbers because I really don't know what they are, but here's 2020, back 5 years. So let me just guess at these numbers: 20, 535, 19, 569, 17, 258, 17, 722, 15, 876. I have no idea if those are the right numbers, but we'll put them there. And then their control level: 2776, 3036, 3007, 2833, and 2582. And I don't think those are correct, but that's okay. But they're in the ballpark. All right, so what is the risk-based capital ratio? Or the risk-based capital ratio is going to be their total adjusted capital divided by the authorized control level RBC times 2. Now why is that? Why do we multiply that by 2? And so what the regulators did is they calculated risk-based capital. And in the law that requires companies to hold that much net worth, They took risk-based capital and they divided it in half, and they called that authorized control level risk-based capital. And they did that at the beginning of the law. They said, okay, here's risk-based capital is this, authorized control level risk-based capital is 50% of that. And then at the end of the law, they said companies need to hold at least 2 times their authorized control level risk-based capital. Well, obviously 2 times the authorized control level risk-based capital is just risk-based capital. They could have left that out of the law entirely and just said firms need to have at least their risk-based capital, but they decided to mess it up. So what we're going to do is I'm going to take the authorized control level, I'll call it ACL here, the ACL RBC times 2, and that is their risk-based capital. And so we just take that number times 2, that number times 2, and I'll copy that over. And then their risk-based capital ratio is just their adjusted capital divided by, so their adjusted capital divided by the risk-based capital. And their ratio is 3.45, and if we copy that over, my guess is they're probably doing better now than they have any time in the past. And sure enough, 2020 is their best year of all. What do you need? Well, the regulators say if you fall below 1, the regulators can step in without having to go to court, and this is the big thing with risk-based capital. In the past, if a regulator was worried about a company going under, they had to go to the courts and get authorization to come in and mandate what management needed to do. What risk-based capital allows state regulators to do is if a company falls below 1, the state has the right to come in and take over the business without having to go to court. The law itself gives them that authorization, so it's a powerful tool. You can see all states 3 times that level because it's a good, healthy company. USA would have been 4 or 5 times as well. Firms, good solid companies like State Farm and USA and Farmers and Allstate and Geico and Progressive, they're going to have much higher ratios than 1 because they don't want be teetering on 1.05 and something goes wrong and now the states are in telling them how to run their business. So that's how the risk-based capital rules. I haven't put this on the exam before, but I might because it'd be a pretty simple question. Give you some free points. So that's the 5-year historical. A lot of good information there. The next thing is hard to read here, but this is that exhibit I showed you that shows all the lines, all this detail. But if you look right here, it's hard to see. That says Texas. This is what we call a state page. So if you go into all states' statutory financials, they will actually have a page for every state that they do business in. So this is their Texas page. So it's pretty amazing detail that you can get. So if you're trying to make a case with, that Texas is a very unprofitable state for insurance companies, well, you have this level of detail. You could pull the biggest, if you're worried about auto insurance, you could pull the biggest auto insurance companies. Now, I don't know if Geico and Progressive had their statutory financials on their websites. They might or might not. It's not really required that they do it. Allstate does, MetLife does, and a few others. So it's possible if you could somehow find those biggest companies and you could sit down and figure out, or at least get Allstate and State Farm and Progressive. You probably can't get your hands on USA's. But get some of the biggest ones, bring them together and say, yeah, Texas is one of the least profitable states in the country for homeowners. We talked about that when we talked about mold insurance. It's one of the most expensive states. There's analysis that you could do. Now think about that SNL.com site. If you actually got access to that SNL website, you could bring in all the Texas data for those biggest companies, and you could actually make a case that, wow, homeowners insurance is really a very different business in Texas than in other states. Here's the Schedule P. We're going to get into Schedule P more, but Schedule P is wonderful, wonderful statement. It's one of my favorite. So it shows you their losses every year, their premiums. So here's their premiums every year. It goes back more years than just 5, so it's even better than the 5-year. Shows that their losses, and it breaks the losses into different categories like defense costs, adjustment costs, the actual losses themselves. So a lot of detail. And then here's where we're going to focus in on is the Schedule P Part 2 and Part 3. We're going to do, so on the exam, we're going to talk about 2 versus 3. So Schedule P Part 2 shows you what they think losses are going to be ultimately. This last column is what they think is going to happen. But it's really important, and you'll see this as we go through the example. What goes across the top are accounting years. This is the way the accountants think. What comes down the side are accident years. This is how the actuaries think. Oops. This is how actuaries think. And so let me give you a couple examples and we'll come back to this. Let's look at 2014. So 2014 and accounting years 2014, the actuaries thought they were going to pay out $15.6 billion in losses. The next year they increased that a little bit to 15.7. The next year it reduced just slightly. The next year it reduced some, reduced it a little bit more, reduced it a little bit more, reduced it a little bit more. But right now, as of 2020, that's their best guess of what that 2014 business is ultimately going to cost them. All right, that's about 15.5 billion. You can see they started off thinking they were going to incur losses of 15.6 billion. Now they just think it's 15.5 billion. So they've come down about $100 million over time. This gets back to what Warren Buffett was saying in that article we read from him when he said firms shouldn't discount reserves because they don't reserve enough. If you look at Allstate, you'll notice most of these numbers, if you go from the first one to the last one, most of these numbers are lower. In fact, every single one so far is lower in 2020 than it was when they initially forecasted. Every single one, all the way down, is lower. So it's not true for Allstate. And this is probably not true for USAA and others. I know USAA, and talking to their loss reservers, they would intentionally overestimate in the first few years by about 3% or so. And so you just expect, just from statistically, for the number to come down over time. We'll talk about the loss development. I'll actually ask you to calculate the 1 year and 2 year loss development. The other schedule we'll look at is Part 3. What Part 3 is showing you is how much they paid so far. So if you look at, let's go back to the 2014. In 2014, they thought they were going to pay out $15.6 billion over time, but at the end of 2014, they'd only paid out $10 billion. So for that business, for 2014, they would have set up about $5.6 billion in reserves because they're expecting over time to pay out $15.6 billion, but at the end of 2014, they'd only paid out $10 billion. But if you come over here to 2020, as of 2020, their ultimate expected payout is $15.5 billion, and they paid out $15.4 billion. So they only have about $100 million, not even that much, about $100 million that they still have in reserve for that 2014 business. We're going to talk about the confusion of this because the accountants look at everything from an accounting year, a fiscal year, but actuaries think of things in terms of accident years. All right, so not only do we get that schedule for the whole company, but here's the schedule just for homeowners. So you can look at just the homeowners business and do the same type of analysis. We'll look at this. It looks like we won't get the Schedule P today. Another thing you might look at if you're interviewing with a firm is the Schedule Y. You can't see all of this, but Schedule Y just shows all of the companies that are part of Allstate. And it looks like a bunch of them, and then you see this letter A, and this letter A references all these other companies. And letter B references all these companies. USAA is just as complex. USAA has a bunch of subsidiaries related to its real estate operations. But if you get in there and look at it, remember we talked about New Jersey being a really difficult state? They probably have an insurance company that just does New Jersey. They probably have a Texas County Mutual. Remember the mold crisis? And these county mutuals. They may have a Texas Lloyd's. On the life insurance side, most life insurance companies that do business throughout the entire United States, they will have a New York only insurance company. They might have an investment subsidiary. USAA has a bank subsidiary. So you might look through this and just see up here at the very, very top, is not an insurance company. This very top company is an Allstate holding company. It's a non-regulated company that owns everything else. And that's the company that when you buy the stock, you're buying the stock in that top holding company. So we won't go into these in detail, but it is actually pretty interesting to go through and look at these things in detail. And then at the very end of the financials, the statutory, they have the investment schedules. I don't find there's a lot of useful information in here, but they do give you some more details about what the company owns. They have a gray schedule here. You cannot see this schedule, but what this schedule does is Schedule D, Part 1A. It shows all the bonds that they own for the current year by rating. So I use this a lot. I want to know, hey, how much do our competitors have in below investment grade bonds? And so that's something I could get out of this schedule. They're not using S&P and Moody's ratings. They're using NAIC ratings. But the NAIC ratings 1, 2, 3, 4, 5, they're very highly correlated. In fact, almost identical to S&P and Moody's ratings. So you really can go in and get some detail. And then the rest of this, I'm not going to go through this. I just want to show you that Allstate's financials, statutory financials, is about 900 pages long. And probably 400 or 500 of that are the investment exhibits. And what this schedule here does, it lists every single bond that Allstate owns. That's the CUSIP for the bond. That's kind of like its ticker for a stock. A description of the bond, all this other information. So I actually dumped all of this information into an Excel spreadsheet once for all of USA's main competitors. It was over 110,000 securities. At the time, Excel didn't have enough lines for me to bring it in. I had to do it in multiple Excel files. So again, that SNL database has this. One thing I always think about is, and it's just incredible to me, this is all produced now electronically, just using accounting software packages. But there was a time where people had to type all of this. Pretty amazing. 800 pages of typing all of these bonds and all of this detail. I can't even really fathom how they would have done it. Just seems. But you see the old TV shows, the old movies, where they have this room and it's just full of people on typewriters typing all day long. And so you talk about productivity in the United States. This is the kind of thing that states require you to do. It'll be interesting to see the history, what this was like before we had typewriters. And back historically, it's been really interesting for me to kind of understand what these must have looked like. Now, when I was at UTSA, we actually had some annual reports that they had kept. Some annual statements, not handwritten, but we had some that were actually typed. And boy, it just gave me chills to look at it because I was the newbie. I probably would have been one typing some of those things. So that's what the statutory financials look like. We'll finish this up as we get into Schedule P to give you a little bit more sense of this. But again, you can see my encouragement to you. If you're going to interview with an insurance company, go find their statutory financials and go through them and call me up or email me, and I'll remind you the things that you should go look at or go back and watch this video. If you do that, they will be very impressed in the interview that you went and did this level of scrutiny and understanding of the company.